local communities as well.
Great, thank you. The Climate Change Committee, which is the independent group advising the government on its sort of climate trajectory, were out this week. I said we're on course for net zero, but they had some pretty big caveats there, as long as policy reform continues. But just on natural capital, one of the points they've made before is that, well, they've set ambitious woodland targets for Scotland. What's your role in meeting those goals, and what policy support would you like to see to help you?
Well, we will be integrally involved in consultation with the governments and local authorities who kind of implement those types of planting of trees, and I think that's an important one, because coming back to we've got to make sure communities are bought into this, and we need planning support in order to turn what typically is unproductive land or agricultural land into things that are productive, and that is again it's a very patient consultation, and it's one which we're used to. We're used to educating and patient consultations. So I think we have a lot of data to support how this is net beneficial to the environment, the communities and investors in order to get through that.
Great, thank you. I mean, the Climate Change Committee did say one of the priority recommendations was to lower the cost of electricity for consumers. I just wondered, and you've yourself have mentioned that grid infrastructure in the UK is one of the bottlenecks. I just wondered what your thoughts were about how to fix that, and what role does GB Energy have in that, do you think, in terms of de-risking investments?
Well, the point you made earlier, technology. Technology exists to manage the grid better today, and we're now at 30 to 40% renewables. We've had a day recently where it was 100% renewables to electricity generation. So the ability to do that exists today with the technology today, and the costs are coming down today. So the requirements to invest in maybe a riskier technology to achieve the goals, you kind of think, well, why? Because we're already potentially doing it today. Where there are legacy systems or operational infrastructure, that is some of the bottlenecks that you refer to. What they call in battery energy storage is often skip rates are too high, i.e. skipping using batteries and preferring to use gas in order to manage the balancing mechanism in the UK electricity, is something we think is not beneficial to the environmental needs, society, and indeed, more importantly, cost. And the moving towards accepting that battery energy storage is a solution for renewables to get from 30-40% to 80-90% would be a very big development for this country.
How long do you think it would take to get to that 80 to 90%?
Well, in 7 years, we expect the projection to get around 35 gigawatts of battery storage capacity, which is equivalent to where the gas capacity is today available. So you could say within 5 to 7 years, you should be in a place where you can actually just use battery energy storage entirely.
And in terms of the grid connectivity, when you look across the planet, is anyone doing a good job? And it feels like it's an issue that touches lots of countries, particularly developed countries. What are your thoughts on that?
When you say a good job, cheaper electricity or more renewables usage?
I think just successfully getting the solar panels connected, for example, to the grid.
So, I mean, look, the UK has done very well. All right, it's solar, wind. We've gone from 15 plus years ago, 20 odd years ago, to 30, 40, 50% now, right? In terms of, so we've obviously done something in the UK pretty well. Continental Europe is not far behind in all of that, so that's in a good place. And the usage of technology of solar and wind is now people don't even consider it as being a risk as in terms of its technology. So I think the globe is in a good place, and the issues is how do you manage that? The electric system in the UK, the grid, is still challenged, and we can see that in some of the pricing. We are in the UK. Pricing of electricity is 2 to 3 times elsewhere in continental Europe, and certainly in America, where it's at least 3 or 4 times more expensive. And so there are benefits that we are not capturing yet in the UK.
And you mentioned, we talked about battery storage a bit, but when you look across all of the different technologies that are evolving in the battery storage space, how diverse is it? How optimistic are you about the quality that you're seeing and the pace of change there?
In battery storage?
In battery storage, yeah.
Well, again, if you stick with lithium-ion technology, which is tried, tested, works, and is coming down in price, there is clearly an acceptance that you don't have to take as too much risk because of that, those case studies and precedents. So I think the globe is in a good place. Of course, the issues are supply chains and such like for lithium ion, but there's no suggestion that that is a constraint on that growth. Um, I think the globe is in a good place to use energy storage alongside tested technology like wind, like solar, in order to evolve into the new energy world that is inevitable. It's coming.
Thank you. And just lastly on sort of the energy transition, I think you previously called for zonal pricing of UK electricity. Why is that, and how how feasible is it, do you think?
I think it's a debate. It's not a black and white answer, but we think that there would be at the margin some improvements in pricing within local communities if you end up, or regions if you end up with zonal pricing. But I think it's definitely not a slam dunk on that debate, and it's very clear when you look at the debate and read about it that this could rumble on for quite a while.
Thank you. So moving away just to the company, Gresham House, it's obviously got strong roots in the UK, but you're increasingly branching out internationally. What is the strategy for the next sort of year, 2 years on that score, and which countries look attractive to you at the moment, and why?
So we're an alternative manager which is quite niche in terms of some of the growing areas of asset allocation. Natural capital, we talked about energy transition and infrastructure are the key areas, but also growth capital like venture capital. We're the second largest venture capital trust investor in the UK. So we're very optimistic that those areas of asset allocation are not just growing within investors, LP investors, but also a necessity for economic growth and the sustainability agenda. Where do we see a lot of that growth? Well, the UK is growing. We mentioned earlier that there are clients in the UK going from 0 to 4% asset allocation in natural capital. That is beginning to happen around the world. Whilst Canada is an example where they're ahead of the curve and already allocating for a number of years to natural capital, they're now beginning to look elsewhere across the globe. They would have looked at North America being, on Australia and New Zealand being areas typically historically to invest. Europe is increasingly on their agenda, and it's very evident that they like the legal systems in Europe. They like the investment processes there, and so I think we'll see over the next couple of years more capital coming from North America, Canada particularly, to do that. And then similarly, when you look to Japan and Australasia, this is well and truly up the agenda in Japan. They're already allocating. I mentioned earlier we have a client there recently from Japan that started after 2 years talking in Japan to clients. And I can see when I've been in Australia to asset allocators, it is on the agenda. It will move up the agenda to allocations over the next couple of years would be my expectation. Some are already doing it directly, but typically in their local region of Australia and New Zealand. So I think it's a very exciting time. I mean, it's incredible if we end up with that, as I mentioned earlier, an independent asset class in a few years' time called natural capital, which is what I expect. It'll be a bit like how much do you allocate to private equity, infrastructure, and how much you've got in natural capital. It'll be a standard discussion topic.
Great. You mentioned North America there. Can we talk about the US specifically? Obviously, it's the big story of the year in so many ways, and it will be for the next couple of years, I'm sure. But in terms of the US, lots of policy decisions by the Trump administration on all things green, in many cases a pullback. How has that impacted your strategy and view of market development there and globally?
What we're seeing is LP investors wanted to come to Europe and talk about it a bit more. That's absolute for sure, both infrastructure, energy transition, and also natural capital. So it's getting people's heads up, and that's applying, I think, elsewhere across the globe. Asia thinking should they invest in Europe more than they did previously, where they would have gone to North America. That is definite. Talking to LPs globally in the last 6 months, no question. That's going to benefit those people who have good platforms in Europe or market shares. Gresham House is one of those, and we are aiming to capture that, and hence by building relationships, partnerships with these large LP investors, allocators around the world. And so it's mean that we've had to get up and get out of our seat and go and meet these guys and tell them the great story that people like Gresham House has to capture the energy transition, the natural capital, or the infrastructure opportunities in the UK and Europe.
And I remember when the Inflation Reduction Act came in, all the credits that the Biden administration gave out, a lot of it was a joke almost, like there were wind turbines ready to be put up in France, for example, they're put on a ship and taken to the East Coast. Is that flow reversing? Is it actually a thing? Are you seeing money move already? Because
Yeah, we are definitely seeing. I mean, money doesn't just overnight, particularly long-term 10, 20-year money doesn't go within a week from I was here and I'm there. But the mere fact that these dialogues are happening, the mere fact that relationships are being built and partnerships and framing of partnerships is happening, it will mean the probability that capital starts coming here over the next 6, 12, 24 months is a high probability.
thank you. And just, any money that does come over here, it is coming to a region where policies have also been rowed back a bit, even in the European context. Various green initiatives have been just pulled back a touch just to maintain competitiveness, is the argument. Are you still confident that Europe is a leader in that regard? Are you expecting an even bigger pullback, or are you confident that we've sort of bottomed out a little bit there?
Capital will go to where financial returns are. If the financial returns are good and attractive with stable environments, they will continue to go there, regardless of any other agenda. So the mere fact that you have additionality, as well as the financial returns, will attract capital. So I'm very confident, if you look at some of the returns we've made in the last 15 years in the UK, forestry, for example, have been 11% plus per annum. Now, that's an attractive return based on a low volatility or low risk basis. Now, not necessarily that's what's going to be going forward, but there'll be significant returns going forward. And if people understand that, the additionality will be an additional component, but the financial returns will always be primary. So I'm very confident, as long as you can put decent asset classes with additionality, with primarily good financial returns, the capital will flow.
Great, thank you. Moving away from organic growth strategy for a second, a lot of flux in the asset management industry more broadly. What are your thoughts around consolidation? Is Gresham House a potential buyer at the moment?
Well, so a bit of a recap. Gresham House, we bought into in 2014. It was effectively a shell company on the London Stock Exchange, and we got it regulated, turned it into an alternative asset manager, and we went on an organic growth and an acquisition growth path. We built a business which had some very strong global and regional market shares in energy, infrastructure, venture capital, natural capital. We were then approached about 2 years ago to go private, and when the board eventually gave shareholders a fair return and price, we went private and backed by a private equity house. But the aim of that was to continue our journey in internationalizing the business, which includes acquisitions and inorganic growth. A very clear path of organic growth, but the consolidation within alternatives was going to continue. Those let's call them mid-market alternative houses who can't push on the regional or global stage, want more distribution, can get some synergies out of business development. That's what we do. We've done it well for over 10 years. We've got a phenomenal team and teams within our business, amazing team players with ambition and capability. And so you should expect us to partake in inorganic or acquisition growth, and you should expect us to develop internationally as part of that.
Is there any sort of rough framing around that? Is there a sort of a certain size of company that you would consider, and are there any geographies that look particularly interesting just because of maybe the number of houses or the pricing?
So the thing the starting point is, how do we add value to a business, and then we'll pay accordingly. So if we found a large acquisition, we'd be able to fund that, in my opinion. As long as it made the return that we need from it in terms of return on capital, but also importantly, part of that will be, how do we develop it? How do we grow its top line? How do we grow its assets under management? So that business development plan is critical to any analysis and investment. If you look in history, you've taken businesses where we bought for only £2 or £3 million, and we've turned them into the largest, battery storage producer in Europe, or asset manager in Europe, with over $1 billion worth of assets under management. So the point being is, it's about where you see vision to create economic growth, backing capable people. So everything from 2 million up to several hundred million is in my mind in terms of what we could buy. But I have a very capable team around me to keep my feet on the ground and make sure we go through the right process and that we can add value.
Great, thank you. You mentioned about the management buy-in and being taken private. Just in terms of the buy-in and the journey, like, how risky was all of that? And is there anything you, in hindsight, would have done differently?
It's definitely risky, and my whole life since sort of leaving university and joining the city is you're meant to take appropriate risk returns. You get educated and taught to do that, and you learn from mistakes. So it was risky when we bought it in 2014. There wasn't anything there. It was just a vision with persuading people that we were going to execute. We did. We executed very well, made a fantastic return for people who lived that journey for about 8 or 9 years. And now we're doing it again with a number of different shareholders. And importantly, we, the management team and employees, own a lot more of the company now than we did when we were on the stock exchange. So we're really proud of what we've got. It was a risk, it's paying off, but everything you do needs to be risky in order to push the boundaries and grow economically anywhere and anything.
Thank you. And you mentioned the PE ownership. How have you found it? First full year chalked up last year. How have you found private equity ownership, and what are the sort of the pros and cons of not being in the public eye?
I've really enjoyed it. I mean, it is different. I'm a big advocate of public markets. Come back to that if we need to, but they have helped us laser-like focus on a 5-7 year plans. You can think about things over the long term without necessarily a daily desire for shareholders to tell us what you're doing. And they have a different perspective, a diverse perspective in many respects that leads us to achieving a value growth plan.
Great. And earlier in your career, you had a variety of roles, including at SVG Investment Managers, Phillips and Drew Fund Management, and the LPFA. You've also played rugby at a high level. So how would you say these various experiences have shaped you as an investor and a manager?
Well, it makes you competitive. Sport particularly makes you competitive. Being in the city is very competitive. It's the top talent that comes to the city in order to achieve financial goals typically. Being in sport, setting goals and getting yourself off the ground when you fail is a massive learning experience, and that happens in the city. Working and enjoying the wins is fantastic, and the celebration, like sport, when you enjoy the wins within a city environment, is fantastic. So I would say I've learned a lot through sport that's allowed me to get off the floor when we make mistakes and learn from them, go forward and go again.
Great, thank you. We're coming up to the end of time, but we've got a couple of last questions if we can get through them. Where do you see the most underappreciated investment opportunities right now, either in the UK or globally?
I'm a contrarian, which means when everybody else is running towards something or away from something, then I like to have a look at where they're running away from. And at the moment, we see the London Stock Exchange is under what, inverted commas, a cloud of people thinking it's not very good for whatever reason. I think that means it will have many opportunities within it that are undervalued because of the dislocation of valuation. So I think that is something that people should focus on. And they genuinely are, particularly in the smaller company areas.
Great. And just very lastly, if you could change one thing about the UK investment landscape tomorrow, what would it be?
The corporation tax rate. If you made domiciled and stock exchange listed companies pay 15%, say, on their corporation tax rate, you would see an enormous attraction and then ultimately an increase in liquidity within the London Stock Exchange, which is a massive goal. If you look in Ireland they lowered 15 odd years ago their corporate rates to 12.5. You'd have thought their corporation tax revenue went down. It didn't. It went up from 4 billion to 22 billion over 10 years. So the benefits to this UK could be enormous, both from the London Stock Exchange, but also from the government's revenues.
Great, Tony. I'm afraid that's all we've got time for. Thanks ever so much for joining us today.
It's a pleasure. I've enjoyed it. Thank you.
Thank you.